Silicon Valley Bank was the 16th largest bank in United States. Silicon Valley Bank is a commercial bank that primarily serves the technology and innovation industries, and it has served around 65% of United States startup and growth stage companies. Means if you have a startup company and you need loan or you want to put some of your company's money, SVB will be your last resort. And now we are seeing everywhere that Silicon Valley Bank collapsed on Friday morning in just 48 hours. But when you say 48 hours on Friday, which means it all started on Wednesday morning. So what happened on Wednesday morning? So on Wednesday, Silicon Valley Bank was the well-capitalized bank, and it was just seeking to raise some funds, which was not a small fund but $2.25 billion. Now late Wednesday, they surprised their investor with the news that it needed to raise $2.25 billion to make up its balance sheet. And that is when the panic started. You told this thing to 10 investors. Those 10 investors told the 100 investors that get your deposits out, this thing is gonna fail. And the panic started. All the customers withdrew a giant amount of $42 billion deposit by the end of Thursday, and SVB had a negative cash balance of $958 million by Thursday evening. SVB found itself short on capital, and it has been forced to sell all of its available for sale bonds at $1.8 billion of loss. And Thursday evening, you would not believe it, some of the SVB customers received an email assuring them that it was a business as usual. But on Friday morning, California regulators closed down the tech lender and put it under the control of US Federal Deposit Insurance Corporation, which is known as FDIC, and it is an insurance company for the banks, which most of the bank uses. Why they put it under that? Because the bank did not have enough capital to pay its customer. Now the question comes, why they needed $2.25 billion? What happened? Many startup companies put their cash at Silicon Valley Bank, and the bank in turn took that money and invested it, including in a bunch of long-dated bonds. Those investments looked relatively safe at that time, but became riskier last year as the interest rate rose and bonds lost some of their values. And this is how the second largest failure of financial institution in United States history happened. Just for your information, the first one was in 2008 with the Washington Mutual, which was heavily involved in the risky mortgage and became the largest bank fail in United States. So those who remain with the bank now can take a breath of relief because the regulator approved a plan Sunday morning to backstop both depositor and financial institution associated with Silicon Valley Bank. The Federal Reserve stepped in with a separate facility that will provide loan up to 1 year for institutions affected by bank failures. Leading regulators said in a joint statement that today we are taking decisive action to protect the US economy by strengthening public confidence in our banking system. And that is a big relief. If I would have put my money into that bank, this statement would have given me a sleep for my night. So I hope you like this video. Thank you so much.